Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good weekend. And good Labor Day weekend, all. Ira Epstein with your agriculture update for this Friday, the first day of September 2017. And we're now at the end of trading in the ag markets. We're about 2:05 p.m. Central Daylight Time. Got to remind you that you get different trading hours in the ag markets than you do in the financials over the Labor Day holiday. And yes, there is electronic trading over the holiday, so you want to check with your broker. But in taking a look at the market, D's corn down today, wheat up 4 1/4, and beans up a little bit on the day. We also saw the dollar come back and the euro come down on the day. Metal markets, a green day, and so far in the stock market, a green day in most of the indices as well. But let's go to the action and see what the monthly chart looks like. And remember, on this particular weekend, every Friday I try to do longer term charts, and then Monday through Thursday I try to do the daily charts for you. It gives you a little mix of everything. Those of you that are subscribers of my research know that we do just about every day a morning video where we cover 40 charts at a time, giving you all kinds of trade ideas. And that brings up two things before I get anywhere here. What makes this work for me is you telling people about us. So tell them about us, where we're at on the YouTube. That gets this going. And yes, our viewership just continues to go, and that makes me good. What I'm looking for, obviously, are people that trade through us, and we get a number of you that do that, and I appreciate it. The second thing, if there's certain markets during the week on the daily charts you want me to cover, I will do it. Just either write me on the website or you can go to YouTube and write a message there. I read them in both spots. All right. So on the monthly chart of beans, we went from 1208.5 back at the beginning of the year, as you can see, in 2016. Let me make this straight. This is a monthly chart, so I said that actually wrong. In 2016, about mid-year. And then we came down to 900.25. And remember, this is a monthly chart, so we got the beginning of September here. So that would have been, if you look at it, August, July, June low so far in the $9 mark, okay? When we take a look at a weekly chart of just closes, this is called an area chart of closes. I'm going to call it in a down thrust because you've gone from $10.75 down to $9.35.5, and now you've come back to the 9.42 area on the close. Remember, this is a weekly chart, not necessarily November beans. It takes the lead month, and that's how we do these. That's called actually a weekly chart. You're rotating with it. You can do also weekly charts of an individual month. I prefer to do it this way. In looking how the market's coming, bingo, you can see the regular chart action. You're caught between 900 and up here into the 1025 area. But when you put the swing lines on the chart, something interesting has happened. If I come back to this chart, you're still looking at it overall bearish. Believe it or not, you have an outside week up. And when you get that, unless you take out this week's low next week or the week after, the market is said in this particular formation have a pattern of higher lows and then a higher high. Because today's high of, this week's high is the right way to say it, this week's high of 944 took out 943.25. That is friendly on the chart. When we also take a chart of the moving averages, you're under them. You're under the 18-week average, which I call the 18-week MAC, moving average of closes, and the 100-week. So what we have is a market that's got the swing line pointing higher. In other words, the short-term trend is turned up. How do you define trend? Well, most traders say that if you have a pattern of higher highs, that's a plural, and higher lows, you're in an uptrend until that pattern is broken. You have that. I define the momentum of a market, or bias is the best word right here, that if the market is trading under the 18-week moving average, it has a negative bias. If it's over it, it has a positive bias. So this is a market that has been negative. It still has a negative bias. Should it rally, the first area I'd see of resistance could be 952.25. the 18-week moving average of closes. When I look at Bollinger Bands, I do it for a reason. A Bollinger Band is an algorithm designed to keep the market trading within it 95% of the time. Now you'll say, okay, 95%, what does that mean? Here's how pros, I think, use it. And this is what I teach in my charting course. Let's assume a market's thrusting to the upside. When the market first hits it, that's where I think the pro's going to take money off the table. If the market's thrusting down, this is where I think the pro's going to take some money off the table. And as you step back, you can see the pattern. I think the neutral point, or the line in the sand on a chart, is the 18-week moving average of closes. So markets that have been downtrends often like to come back to that to regroup. Do they have to stop here, or can they just slice through it? Well, weekly charts are a lot different than daily. If you go to daily charts, you'll see the market plays around that a lot more than it does on the weekly. Suffice to say, I still see the resistance right there. Momentum in the chart, well, it's like turning a ship, a big oil tanker. It doesn't just turn on a nickel. It moves slowly, and what this chart is trying to do is end that. It hasn't done it yet. There's still downside momentum. It's trying to end it. So I call this a chart that could be in a transition, but if you take back out the week's lows, I think you're right back in the downtrend. On the meal market, the trend of the market is down. You have a pattern of lower highs, lower lows, down. On the week, the market is underneath the 18-week moving average. That is bearish. Momentum is pointing down. So I view this chart as still very much in a bear framework. In the oil market, the part of the soybean oil, momentum is up. The bias is up because you're going, as you can see, over the 18-week moving average of closes, but you're at a key resistance point being the upper Bollinger Band. Now, the odds of staying above or below a Bollinger Band are 5% of the time. And each time successively that it goes, let's assume this week up and over it, next week, well, that would be 2 weeks in a row of the 5%. I would say then there'd be a 3% chance of staying over it. So right now, the way that I teach, doesn't mean I'm right, but it's the way that I like to teach. I look at it, there's a 4% chance of the market staying over it next week. Certainly the bias is up and momentum is up, and I do trade and use the stochastics a little bit different on weekly charts than I do on the daily. When it comes to the corn market, this is a market that's got lower highs, lower lows. That's bearish. The market finished today at the 340 level, which is literally right at the lower Bollinger Band. So it did not close under it. It closed on it. There's a big difference there. It closed under it before, so the market's staying within that 5% tolerance. What I see this market doing is it's continuing to push the band down. Now, a lot of traders think that because we had strong daily reversals in the December contract this week, that a low is in place. They may well be right. September sometimes offers that, but you don't see it yet on the weekly bar chart, and what you need is a better pattern. But let's assume they're right. Back up here is the resistance at the 362, 366 3/4. Let's assume they're wrong. I think you'd know that by taking out this week's low of 328.5 on the weekly chart. Momentum is down and the bias is still down. On the Chicago we had a big reversal. The market has come down since over the 550 level with a pattern of lower highs, lower lows. And suddenly we have an outside week where you closed higher. I'm going to say it again. When I get outside weeks, unless you take out the low of that week, the very next week or the week after on a weekly chart, the odds favor the market's trying to build some momentum on the chart basis to rally. And if it does, I have two targets here, the 444 3/4 level, 453 3/4. Now keep in the back of your mind, the market is underneath these numbers. When you're underneath those numbers, the way that I teach charting, and I am telling you, in my charting course, I think you'd learn a lot from, is no, I'm not a buyer there. It's one thing to want to come out of shorts. It's a very different thing to want to get long when you're underneath these key averages and momentum is still pointing down and the bias is still down because you're under that 18-week average of closes. In the cocoa market, you have a pattern of higher lows, higher highs. The market has been going sideways for a very long period of time, staying within these bands. And really, if you study the chart, it's got a small uptrend, but each time it's been going, it's only one time so far, to the upper Bollinger Band, it's been stymied. The downside is where I can use the word each time, because each time it's tried to break lower, it hasn't been able to. So I'm going to call this chart bullish. It's got the short-term trend up, higher highs, higher lows. It has the market with the close over the 18-week moving average of closes, bullish, and momentum is slightly pointing up. What would break that is taking out 1829, the low of 2 weeks ago. In the sugar chart, sugar is a market looking for direction. It has a pattern of a higher high and a lower low. The rally back up just stopped itself where? That number I call the line in the sand, the 18-week moving average of closes. The market will revert to a downtrend on the weekly chart if this week's low of 1363 is taken out. You're only 12 points away from it. Why? That would then give you the pattern of lower highs. You already got the lower lows under the 18-week moving average of closes. Now, momentum is trying to point higher. So we'd have to see how that all plays out. And the weekly chart just gives me a bigger picture. It's the daily charts I really pay and would recommend that traders trade off of. When I come to the coffee chart, we have a market that's gone from the lower Bollinger Band to the higher band. Now imagine you're a trader and you see that you get up there. Remember, you're only going to stay over it 5% of the time or under it 5% of the time. It's not a bad area as I teach it. You don't have to agree with it. The traders look to maybe cut down on contracts or coming out of the market, whatever they decide. I view this chart as having downside momentum. The red line is still pointing down. The market closed under the 18-week average of closes. The bias is down. If the market can take out this week's low, you will have a pattern then of lower highs. The way the swing line sets up, you already have the lower lows. Could it all reverse if later in the week you do something different? Yes, but right now that would be how I'm looking at the chart, and we'll see if the market can go back down and challenge support in that 119.25 area. In the cotton market, after a very big and long break going from mid-May all the way down into the beginning of July, the market on the weekly chart has finally turned up. You have a pattern of higher lows and higher highs. It is not bullish. There's a difference between turning up, because the short-term trend turned up, and the actual bias turning up. It hasn't. You're still under that 18-week average, but momentum has turned. So you have a market in a transition right here, and it certainly is held the 100-week in green moving average of closes very, very well. In the cattle market, you are still very much in a bear phase. You have lower highs marked by the arrows, lower lows. You have an outside week down. What is an outside week down? It means you took out the previous week's high and low, you closed lower. In addition, momentum is locked in bearish. So unless you take out this week's high, which was at 107.40, the odds favor the market's going to continue to keep its bias to the downside. Should you take that out, well, that might create what's called a bear trap, and you could get a heck of a rally out of it. But right now the bears have control of that market. Same in the hogs. But in the hogs, I want you to pay attention. You have now gone from upper Bollinger Band to lower Bollinger Band. Momentum is pointing down. The bias is down. You are underneath the 18-week moving average of closes. The pattern's not ideal on the weekly chart. You got a higher high and a lower low. But the market is certainly in a bear phase. So I put that all together, try to come up with ideas for you, and guess what? I have another idea. I don't know how many of you look at in and out trading, but there is a way called, a technique called pivot points. Pivot points are not something we developed. They have been around a long time. But if you watch them and learn how to work with them, your eyes are going to open up, because you're going to say, now I'm getting why out of nowhere this market stalls at this number, or the market rallies or breaks off of a number. And what I've done is I've created 2 teaching videos for you. The first, I take animation and teach you the concept of what it is with the formula for it. It's very simple. Do you really need to do the formula? No. But it's great to know what the formula is, and I show it, and I give you different ideas with it, because FX traders might use it one way, other traders another, so I point that all out. Then I take you to a regular chart and show you how it's worked in real time. And no, I don't pick just winners or just losers. I show you what I'm seeing. I'm doing a third video in September for you. I wanted to wait for the fall to get this going. And that's going to show certain of you how to use momentum with that and some of the other techniques if you're interested in and out trading where you go home at the end of the day with no position. Do people use this technique to enter a market and hold a position? They do as well. I know I do. So if you're interested in learning, I'd like to make this available to you. It's free. Give us a call. You can leave your name and number on our phone over the holiday. You can always go to our website, www.iraepstein.com. Sign up for it. You'll see a carousel of free offers. You can click right up here at any point. If you're watching me on YouTube, you're going to see an icon. Click on that. The forums will appear. Or underneath us on many websites that carry these videos, it says, click here for Ira's free offers, and away you go. I'm Ira. You have yourself a great Labor Day. I'll see you all Tuesday. Take care now.